Welcome. In this chapter, we'll explore the world of exchange-traded currency futures. You'll learn what currency futures are, why they were introduced in India, and how they differ from forward contracts. We'll also cover essential concepts like interest rate parity and how currency futures are priced. By the end, you'll have a solid understanding of the terminology, mechanics, and practical aspects of trading currency futures on recognized exchanges. Let's begin our journey by understanding the basics and the rationale behind these financial instruments. Currency futures are standardized contracts traded on organized exchanges. They allow participants to buy or sell a fixed amount of one currency against another at a predetermined price on a future date. Unlike forward contracts, which are private and customizable, currency futures are standardized and their settlement is guaranteed by clearing corporation. This means that both buyers and sellers can trade with confidence, knowing that the exchange ensures the contract's fulfillment. Let's look at how these contracts are structured and why they're so important in today's financial markets. Futures contracts have several defining features. First, the exchange determines all contract terms except for price, ensuring standardization. Trading occurs on a centralized platform, allowing for transparent price discovery through the interaction of buyers and sellers. Both parties must pay margins, which act as a security deposit. The contracts have a fixed expiry date and standardized lot sizes, making trading more accessible and reducing ambiguity. These features collectively make futures contracts more liquid, transparent, and secure compared to their forward counterparts. India's journey with currency futures began in August 2008 when the NSE launched its currency derivatives segment. Initially, only USD-INR contracts were available. Over time, the market expanded to include EUR-INR, GBP-INR, and JPY-INR contracts. In 2018, cross-currency futures such as EUR-USD, GBP-USD, and USD-JPY were introduced. These contracts allow participants to hedge or speculate on currency movements, not just involving the Indian rupee, but also major global pairs. This expansion has provided more flexibility and opportunities for traders and investors. Navigate currency futures, it's essential to understand the key terms. The underlying asset is the currency pair, such as USD-INR or EUR-USD, whose value determines the contract's price. The spot price refers to the current market price of the currency pair, while the futures price is the agreed price for future delivery. On the expiry date, the futures price converges with the spot price. Other important terms include quotation, contract cycle, expiry date, tick size, contract value, trading hours, base price, price band, mark-to-market, daily settlement price, final settlement price, and open interest. Mastering these terms is crucial for effective trading. Spot price is the current market rate, which a currency pair can be bought or sold for immediate delivery. In contrast, the futures price is the agreed-upon price for a transaction that will occur at a future date. While these prices may differ during the contract's life, they converge on the expiry date. Understanding this relationship helps traders anticipate market movements and manage risk effectively. The difference between spot and futures prices can be influenced by factors like interest rates, market expectations, and time to expiry. Quotation refers to how the price of a futures contract is expressed. For example, USD-INR futures are quoted as the exchange rate in Indian rupees for $1, while JPY-INR is quoted for 100 Japanese yen. The contract cycle defines the period over which a contract is traded. Contracts can be weekly, monthly, or quarterly, with near, mid, and far-month contracts available. Cycle ensures continuous trading opportunities and allows participants to choose contracts that best suit their hedging or speculative needs. Expiry date, also known as the last trading day, is when trading in a futures contract ceases. For monthly currency futures, this is typically 2 working days before the last business day of the month, ending at 12:30 p.m. Tick size is the minimum price movement allowed in the contract. For example, if the tick size for USD-INR futures is Rs. 0.0025, prices can move in increments of this value. These features ensure clarity and precision in trading, helping participants manage their positions effectively. Each futures contract has a standardized lot size, which specifies the amount of the underlying asset. For instance, the lot size for USD-INR is $1,000. The contract value is calculated by multiplying the futures price by the lot size. This standardization simplifies trading and ensures that all participants are dealing with uniform contract specifications. Understanding contract size and value is essential for calculating margins, transaction costs, and potential profits or losses. Currency futures are traded during specific hours, typically Monday to Friday from 9:00 a.m. to 5:00 p.m. or 7:30 p.m. for cross-currency contracts. On expiry days, trading ends earlier at 12:30. The base price acts as a reference for the start of each trading day. On the first day, it's the theoretical futures price, while on subsequent days, it's the daily settlement price. These mechanisms ensure orderly trading and help participants plan their strategies. Bands set the allowable trading range for a contract on a given day, usually as a percentage above or below the base price. This helps prevent erroneous trades at unrealistic prices. Mark-to-market, MTM, is the process of adjusting open positions to the daily settlement price, ensuring that gains and losses are realized each day. Margins are collected from those with losses and paid to those with gains, maintaining market integrity and reducing default risk. Daily settlement price, DSP, is typically the volume-weighted average price of trades in the last 30 minutes of trading. If unavailable, it defaults to the theoretical price. The final settlement price, FSB, is derived from the spot market on the last trading day. All open positions are settled at this price, either through cash or physical delivery. In India, currency futures are currently cash settled, meaning only the profit or loss is exchanged, not the actual currencies. Open interest represents the total number of outstanding contracts that have not yet been settled. It reflects the depth and liquidity of the market. For every long position, there's a corresponding short position, so open interest counts only one side. High open interest indicates active trading and greater market participation, while low open interest may signal limited activity. Monitoring open interest helps traders gauge market sentiment and potential price movements. The derivatives market, participants can take long or short positions. A long position means buying futures contracts, expecting prices to rise. A short position involves selling contracts, anticipating a price drop. An open position refers to any outstanding contract, whether long or short, that hasn't been closed. Managing these positions is key to effective trading, as it determines exposure to market movements and potential gains or losses. Opening a position means entering into a new contract, either by buying or selling, which increases your exposure in the market. Closing a position involves executing an opposite trade to your original one, thereby reducing or eliminating your exposure. For example, if you bought a contract earlier, selling the same contract closes your position. Understanding how to open and close positions is fundamental for managing risk and locking in profits or losses. Payoff charts are graphical tools that show the potential profit or loss from a futures position as the price of the underlying asset changes at expiry. The x-axis represents the market price at expiry, while the y-axis shows profit or loss. For futures contracts, both long and short positions have unlimited profit or loss potential, resulting in linear payoff charts. These charts help traders visualize outcomes and make informed decisions. Say you go long on a futures contract at Rs. 100. If the price at expiry rises to Rs. 101, you make a profit of Rs. 1. If it falls to Rs. 99, you incur a loss of Rs. 1. The path is linear. For every increase in price, your profit increases by the same amount, and for every decrease, your loss grows similarly. This straightforward relationship makes long futures attractive for those expecting prices to rise. Now consider a short futures position at Rs. 100. If the price at expiry drops to Rs. 99, you profit by Rs. 1. If it rises to Rs. 101, you lose Rs. 1. The short futures payoff is also linear, but in the opposite direction. Profits occur when prices fall and losses when prices rise. This makes short futures suitable for those who anticipate a decline in the underlying asset's price. Payoff chart for both long and short futures positions is symmetrical and linear. For a long position, the line slopes upward, indicating increasing profits as prices rise. For a short position, the line slopes downward, showing increasing losses as prices rise. These charts are essential for understanding the risk and reward profile of futures trading, helping traders plan their strategies accordingly. Currency futures contracts involving the Indian rupee include USD INR, EU INR, GBP INR, and JPY INR. Each contract has a specific lot size, 1,000 units for USD, EUR, and GBP, and 100,000 units for JPY. Prices are quoted as the exchange rate in INR for the respective currency. These standardized specifications make it easier for traders to understand and participate in the market, ensuring transparency and consistency. Cross-currency futures contracts, such as EUR-USD, GBP-USD, and USD-JPY, are also available. These contracts have lot sizes of 1,000 units for EUR and GBP and 1,000 units for USD in the USD-JPY pair. Prices are quoted in the relevant foreign currency, and settlement is in Indian rupees. These contracts allow traders to hedge or speculate on global currency movements, expanding the range of opportunities beyond INR-based pairs. INR-based contracts, there are 11 serial weekly cycles and 12 serial monthly cycles. New contracts are introduced after the expiry of the current ones. Weekly contracts expire every Friday at 12:30 p.m., while monthly contracts expire 2 working days before the last business day of the month. Cross-currency contracts follow a 12-monthly cycle with expiry 2 working days before the month's end. These cycles ensure continuous trading and flexibility for market participants. All currency futures contracts in India are cash settled in INR. The daily settlement price is based on the volume-weighted average price of the last half hour of trading. The final settlement price is determined using the FBIL reference rate for the relevant currency pairs. Settlements occur on a T+1 basis for daily MTM and T+2 for final settlement. This system ensures timely and accurate settlement of all trades, reducing counterparty risk. Lot size is the minimum tradable unit for each contract. For example, USD/INR contracts have a lot size of 1,000 USD, while JPY/INR contracts have 100,000 JPY. The contract value is calculated by multiplying the trade price by the lot size. This standardization helps in determining margin requirements, transaction charges, and regulatory fees. Understanding lot size and contract value is crucial for effective risk management and capital allocation. Size is the smallest possible price movement in a contract. For INR-based contracts, the tick size is INR 0.0025. For cross-currency contracts, it's USD 0.0001 or JPY 0.01, depending on the pair. Each tick represents a specific change in contract value, which is important for calculating potential gains or losses from small price movements. This precision allows traders to fine-tune their strategies and manage risk effectively. Both futures and forward contracts serve to hedge against price uncertainty. They differ in several ways. Futures are standardized, traded on exchanges, and settled through a clearing corporation, eliminating counterparty risk. Forwards are customized, traded over the counter, and settled bilaterally, which can introduce more risk and less liquidity. Understanding these differences helps traders choose the right instrument for their needs. Futures contracts offer several advantages, including price transparency, elimination of counterparty risk, and high liquidity. They are accessible to a wide range of market participants and provide easy entry and exit. However, their standardized nature may lead to imperfect hedges for specific needs, and since they are cash-settled, users must access the spot market for actual delivery. Operational issues related to margin and mark-to-market settlement can also arise. Forward contracts are highly customizable, allowing parties to tailor contract size, expiry date, and other terms to their specific needs. This makes them ideal for unique hedging requirements. However, they carry higher counterparty and liquidity risks as they are not traded on exchanges. Settlement is typically through physical delivery, and information is less transparent compared to futures. These factors must be weighed when choosing between forwards and futures. Interest rate parity is a fundamental concept in currency futures pricing. It states that the difference between the spot and futures price of a currency pair reflects the interest rate differential between the two currencies. If interest rates are high in one country, its currency will trade at a discount in the futures market, and vice versa. This relationship ensures that arbitrage opportunities are minimized and that futures prices remain fair and efficient. Let's illustrate interest rate parity with an example. Suppose the spot rate for USD/INR is 83, the one-year risk-free rate in the US is 5%, and in India it's 7%. If you borrow 1 USD in the US, convert it to INR, and invest in India, you'll need to convert your INR back to USD at the end of the year. The futures price is set so that there's no risk-free profit from this transaction. Using the formula, the one-year futures price ensures that the return in both currencies is equalized, preventing arbitrage. The formula for interest rate parity is Fs equals 1 plus INR, 1 plus IUSD, where F is the futures price, S is the spot price, INR is the Indian interest rate, and IUSD is the US interest rate. This formula ensures that the futures price reflects the interest rate differential. More accurate version uses continuous compounding. F equals S AMS AF AMS T, where R and AF are the interest rates for the quote and base currencies, and T is the time to expiration. When the futures price of a currency pair is higher than the spot price, the base currency is said to be at a discount and the quote currency at a premium. For example, if the 6-month USD/INR futures price is 83.81 and the spot is 83, INR is at a discount to USD. This reflects the higher interest rate in India compared to the US. Understanding premium and discount helps traders anticipate market movements and make informed decisions. The interest rate in the US rises, while India's rate remains constant. The USD/INR futures price will decrease. This is because the interest rate differential narrows, reducing the premium of USD over INR. Traders monitor interest rate expectations closely, as changes can significantly impact futures prices and trading strategies. Being aware of these dynamics is crucial for successful currency futures trading. Suppose the 6-month interest rate in India is 3.5% and in the US is 2.5%, with a spot rate of 83. The 6-month futures price is calculated as 83 times 1 plus 0.07 times 0.5, 1 plus 0.05 times 0.5, resulting in 83.8097. If the US rate increases to 5.25%, the futures price drops to 83.7076. This demonstrates how interest rate changes directly affect futures pricing, reinforcing the importance of monitoring economic indicators. Let's consider EU or JPY, where the one-year interest rate in JPY is 0.25% and in EUR is 1%. With a spot rate of 123.4, the one-year forward rate is 122.4837. Since EUR has a higher interest rate, its future value is at a discount to JPY. This example reinforces the principle that the currency with the higher interest rate will trade at a discount in the futures market. Theoretical price of a currency futures contract is calculated using the formula F equals S times ERRF times T here. S is the spot price, R is the interest rate for the quote currency, RF is the rate for the base currency, and T is the time to expiration. This formula ensures that the futures price accurately reflects the interest rate differential and the time value of money, providing a fair and efficient market for all participants. Currency futures are valuable tools for hedging against currency risk, speculating on exchange rate movements, and arbitraging price differences. They offer transparency, liquidity, and standardized terms, making them accessible to a wide range of participants. Whether you're an importer, exporter, investor, or trader, currency futures can help you manage risk and seize opportunities in the global currency markets. One of the main advantages of exchange-traded currency futures is their high liquidity and transparency. Standardized contracts and centralized trading platforms ensure that prices are determined through open competition among buyers and sellers. Information about prices, volumes, and open interest is readily available, enabling informed decision-making and efficient market functioning. Buyers and sellers in currency futures must maintain margin accounts. Margins act as a security deposit, ensuring that participants can cover potential losses. Daily mark-to-market adjustments help manage risk by settling gains and losses each day. This system protects the integrity of the market and reduces the likelihood of defaults, making futures trading safer for all participants. Clearing Corporation plays a crucial role in currency futures trading. It acts as an intermediary between buyers and sellers, guaranteeing the settlement of all contracts. This eliminates counterparty risk and ensures that trades are executed smoothly. The Clearing Corporation also manages margins, daily settlements, and final settlements, maintaining the stability and reliability of the market. In trading currency futures, it's important to choose the contract that best fits your needs. Consider factors like the underlying currency pair, contract size, expiry date, and liquidity. Assess your risk tolerance and trading objectives before entering the market. By selecting the right contract, you can optimize your hedging or speculative strategies and achieve your financial goals more effectively. Suppose you're an importer expecting to pay for goods in USD in 3 months. By taking a long position in USD-INR futures, you can lock in the exchange rate today, protecting yourself from adverse currency movements. If the rupee depreciates, your futures position will gain, offsetting the higher cost of your import payment. This practical use of currency futures demonstrates their value in managing real-world financial risks. Currency futures also attract speculators and arbitrageurs. Speculators aim to profit from expected movements in exchange rates, while arbitrageurs exploit price differences between markets. The standardized and transparent nature of futures contracts makes them ideal for these strategies, contributing to market liquidity and efficiency. However, these activities also carry risks, so careful analysis and risk management are essential. Summary: exchange-traded currency futures are powerful tools for managing currency risk, speculating on exchange rates, and arbitraging price differences. They offer transparency, liquidity, and standardized terms, making them accessible and reliable. Understanding the mechanics, terminology, and pricing of currency futures is essential for successful participation in this dynamic market. Whether you're hedging, speculating, or arbitraging, currency futures can help you achieve your financial objectives. As we wrap up this chapter, remember that currency futures in India are regulated by both SEBI and RBI, ensuring a robust and secure trading environment. In the next chapter, we'll delve into the regulatory framework governing currency derivatives, exploring the rules and guidelines that protect market participants and maintain market integrity. Stay tuned for a deeper understanding of how regulation shapes the currency futures market.